Welcome to the Accounting Fundamentals course. This program has been developed by ACA qualified chartered accountants with Big Four industry training in the UK, bringing together both technical expertise and first-hand experience of the exam journey. This course is ideal for anyone preparing for their ACA exams, whether you're studying independently, fresh out of university, or still adjusting to a completely different style of learning. Many students find that in-person classes at tuition centres like Kaplan can feel rushed, with tutors often covering topics at a very high level. That pace can be challenging if you're sitting accounting exams for the first time, and especially if you don't come from an academic accounting background. ACA textbooks are famously huge. Some professional level books run close to 2,000 pages, and realistically, no one has the time or the willpower to read every single word when you only have a few weeks to prepare. The aim of this course is to save you time by cutting through the heavy reading and focusing on the areas that actually matter for passing your exams. With that in mind, let's dive into Chapter 8 of the Accounting Fundamentals course. In this chapter, we're going to explore two major topics: irrecoverable debt expense, also known as a write-off of bad debt, and allowances for receivables. These two areas are commonly tested in the exam and often appear as adjustment requirements in long-form questions. In the exam, you'll be expected to demonstrate your technical understanding of the double entries for both irrecoverable debt expense and allowances for receivables, as well as how these items are presented in the financial statements. In the next slide, we'll break down the different types of double entries you may encounter in your Accounting Fundamentals exam. The learning objectives for this course are aligned with the content of the Accounting Fundamentals textbook. In this chapter, we introduce two key accounting concepts: irrecoverable debt expense and allowance for receivables, within the context of company accounts. We will begin with irrecoverable debt expense, starting with its technical definition to help you understand the underlying accounting concept. From there, we will look at the accounting treatment in detail and work through the double entries required for irrecoverable debt expense. You will then apply this knowledge to prepare journals for three different categories of transactions that fall under irrecoverable debt expenses. The first category is write-offs of customer debt. This occurs when a business determines that a customer's outstanding balance is no longer recoverable, often due to default or insolvency. This is the most common type of adjustment you will encounter in your exam, so it is essential to practice these questions to secure strong marks. The second category involves reversals or derecognition of previously written-off debts. This situation arises when a customer makes a payment after their debt has already been written off. This adjustment is also frequently tested, and you will need to know the precise double entries required both to record the receipt of funds and to correctly reverse the earlier irrecoverable debt expense. The final category of transaction is dishonoured payments. This occurs when a customer attempts to make an electronic payment, but the transfer fails to process, often due to a technical issue at the bank. Although this type of question appears less frequently in the exam, it is still important to understand the required double entries so that you feel fully prepared. For each of these transaction types, we will work through practical examples taken from the question bank to reinforce your understanding and help you apply the concepts confidently. We will then look at how irrecoverable debt expense is presented in a company's financial statements. Next, we will introduce the concept of allowances for receivables. Please do not confuse this term with trade receivables. They are two distinct concepts, although they are closely linked and directly affect one another. We will start with the technical definition of allowances for receivables and explain why a provision is raised in the first place. We will then go through the accounting treatment in detail. For this exam, you will need to be comfortable with the double entries in the following situations. Initial recognition of an allowance for receivables. This is when a business creates an allowance for the first time. We will look at the double entries required to record this initial provision. subsequent adjustments to the allowance for receivables. This is when a business revises its allowance during the year, either increasing or decreasing it. For example, a business may decide to increase its allowance because it expects more credit customers to default. The double entries will differ depending on whether the allowance is being raised or reduced, and we will work through both scenarios. We will also cover several other key aspects of Chapter 8: how to calculate the net trade receivables balance and how this is presented in the Statement of Financial Position. The impact of irrecoverable debts on gross profit and overall profitability, so you can see how these adjustments flow through the financial statements. How to adjust trial balances for both irrecoverable debts and allowances, a skill that is commonly tested in the Accounting Fundamentals exam. Finally, we will bring the two concepts together. We will work through examples that combine both irrecoverable debts and allowances, so you can see how to handle exam-style adjustments in practice. We'll conclude the chapter with worked examples and exam-style questions, giving you the opportunity to apply everything step by step. By the end of this session, you should feel confident in dealing with both irrecoverable debts and allowances, and ready to demonstrate that knowledge in your exam. So, what is irrecoverable debt expense? The textbook definition of irrecoverable debt expense is that it is an amount of customer debt not expected to be recovered. It effectively represents a cost to a business. Let's now explain how the double entries work for debts that are written off. We begin by debiting the irrecoverable debt expense account in the statement of profit or loss. This is because writing off a bad customer debt represents a cost to the business. More specifically, it is treated as an administrative expense, which means it appears as a debit entry in the trial balance under administrative expenses, not under cost of sales. This is an important exam point. When preparing the statement of profit or loss, adjustments for bad debts should always be made to administrative expenses, never to cost of sales. We then credit the trade receivables account in the Statement of Financial Position to create the balancing entry. By crediting trade receivables, we reduce the amount the business originally expected to receive from the customer by the value of the debt being written off. To understand this more clearly, let's revisit how the original sale would have been recorded before the customer defaulted. When a credit sale takes place, the business would typically credit revenue and debit trade receivables. Later, if the customer fails to pay, the business recognizes the write-off by applying the double entries we've just discussed. Notice that when a business writes off a bad debt, revenue remains unchanged. This is because the sale has already occurred. The business has delivered the goods or services. This has an important implication for gross profit. Writing off a debt does not affect gross profit, as neither revenue nor cost of sales is adjusted. Instead, the impact is reflected further down the statement of profit or loss, within administrative expenses. So that's the accounting treatment and presentation of irrecoverable debt expense. Now let's look at a worked example to see how a write-off of bad debt operates in practice. Practice. Question 1. Customer debt write-off. Question. A customer buys a bicycle on credit terms for £1,200. At a later date, due to financial difficulties, this customer defaults on the outstanding balance. After assessing the situation, the car company determines that the debt is irrecoverable and decides to write it off. Prepare journal entries to account for the write-off of bad debt. You can pause the video here and come back when you're ready. Otherwise, let's work through the question together. From the requirement, we can clearly identify the amount of debt being written off: £1,200. To account for this, we need to create the following double entries. Debit irrecoverable debt expense in the statement of profit or loss, £1,200. Credit trade receivables in the statement of financial position, £1,200. Why do we do this? Debiting the expense recognizes the cost of the bad debt. Crediting trade receivables reduces the amount we previously expected to collect from the customer because this particular balance is no longer recoverable. Now let's think about the presentation. In the statement of profit or loss, the £1,200 appears as an adjustment under administrative expenses. This increases expenses and therefore reduces overall profit. In the statement of financial position, trade receivables are reduced by £1,200, ensuring the balance sheet reflects only the amounts the business realistically expects to collect. And that's the full double entry and financial statement impact for a bad debt write-off.